Our next guest says the market's fairly valued here, but that energy might still have some room to run. RBC Capital Markets head of U.S. equity strategy, Lori Calvasina, target of 5,300, joins us here at Post 9. It's always good to see you, Lori. Thanks for coming in. Good to see you, too. You wrote in March, and I love this, the way you put it, feeling a little more neutral these days, but not bearish. Is that still true?
Yeah, that's still true. And look, I think there's a camp of, really big optimists, and there's a camp of really big bears. And I'm really not in the big bear camp, right? And I've been one of the more optimistic strategists, but I feel like I've cooled my heels a little bit just based on what we're seeing in the data and the numbers.
What would it take then to get you more bullish?
So I think that we've, when we look at our valuation work, in terms of where current interest rate assumptions are, inflation assumptions are, the market looks pretty fairly valued. So I think I'd need to see some change there. Maybe a bigger than anticipated moderation in inflation could do it. I think the other thing, I really think we've got to have a little bit of a pullback in the market. And I know I've been saying that for a while, but we really see, someone was focusing on investors' intelligence recently. I look at AAII, CFTC. You can also look at the University of Michigan Consumer Sentiment Survey and expectations for the stock market. All these things are sort of creeping around all-time highs or at levels right below them where you typically see a bit of a pullback. So I think that we've got to have a little bit of a breather in here.
Where are you on earnings these days? Given a stronger economy, which of course may mean that we do not necessarily see that lowering of rates that. Anyway, where are you on earnings?
Yeah, so I'm at 237, and I think the street consensus is now up to 246. When I published my number, the consensus was still around 243. So it's bumped up a couple bucks as people have gotten ready for earnings season. The big thing that I took out of my model versus the prior update was I don't have any buybacks baked in for this year. And that's really because if you look at the share count, it's been kind of flattish over the last couple quarters. And I previously had some big buybacks in. So all the economic assumptions, the GDP forecast really improved since we first put out that forecast in January. So that was an actual up pressure on the earnings number, but it really got eaten up by the buyback assumption that we ratcheted down.
And are you including any productivity gains and therefore margin improvements as a result of AI?
No, and it's funny. I think margins are ridiculously hard to forecast, and we're very open about this. I've got flat margins in my model, and I basically just made the assumption that they're going to be flat because all of the different macro variables that I have used in the past to forecast margins are not working right now. And I think that is in part because of things like productivity enhancement. I think, frankly, we also just have very skilled management teams that have been tested by one thing after another since 2018, trade war, COVID, supply chain disruptions, and that talent, as a forecaster, that's not a quantitative input that I can put in, right? So I've been very humble about our earnings numbers, saying there could be some upside to our view because we could get some margin expansion just based on all those things.
It kind of reminds me of what Chuck Robbins told us a few quarters ago, is that corporate America is populated with executives who've been through the mill over and over again, right? And it's just refined their management prowess.
Yeah, it does make you obviously more effective, I guess, in a crisis. We seem to have a lot of them. That's interesting, though, that none of your metrics are working.
They're not working. And for a while, I was like the last year, I've been using copper prices and rate of change on GDP, and even those two things aren't working so great right now. So I finally just got frustrated and pulled them out of the model and just said, based on what I was reading in 1Q, I did feel like I was still seeing a lot of complaints about cost pressures that surprised me. The pricing discussion was waning. I wouldn't say people are abandoning pricing, but it seems like that's, kind of decreasing in terms of its efficacy. But the cost pressures are probably still higher than I anticipated. Labor is still seen as a big challenge. So when I walked through it, and I also felt, frankly, like in this last reporting season, calendar 1Q at least, the management teams were trying to rein in expectations a bit. There was not anything, sort of nefarious about the economy that I was reading, but I did feel like they were trying to clamp down the enthusiasm. So I'll be watching in this next reporting season, frankly, to see what they're seeing on all these things. And I could be wrong on some of this stuff, but we're just going to have to see.